Welcome to Data Everywhere. I'm going to move that down so I'm not yelling at everybody. Better? Volume has never been a problem, so let me know. We're going to discuss data, payments, and all the good things that you can do with it, some legal, some not legal. I'm Kirsten Thompson. I'm a partner at the national law firm McCarthy Tetrault. I lead the firm's cybersecurity, privacy, and data protection group. And this is Anna Badour, a partner in our financial services group. So this is a bit of an outline of what we're going to talk about today. Key point of data monetization. First of all, what is it and why does it matter? Some of you will already know that. Some of you will make your living answering that question. Some of this will be new to other people. Then we're going to talk about the legal framework. Not all the legal framework, you'll be delighted to know, just two aspects of it. Privacy, which is my area, and the financial regulation piece, which is Anna's area. And then after telling you all about the challenges of doing this, we're going to tell you how to make it all work. So let's start with big data. So what is big data? It's pretty self-explanatory. It's data, it's big. It's vast amounts of data arriving at a very fast rate and featuring a mix of data types, so not just spreadsheets. And big data as a concept isn't new. If you think back 50 years ago, big data was exactly what bank managers did. They knew who you were, they knew how many kids you had, they knew you cheated on your spouse and you drank too much on weekends. On the basis of that, they made credit decisions. What has changed is the technological aspect. So now there's more data points coming in, and instead of a person, we're now analyzing data points. So it's the technology that's really changed. And now that we don't have relationships with people, but we have relationships with data, this leads to customer intimacy problems, which is not as bad as it sounds. There's no blue pill for that. But the whole aim of big data and data monetization is to get that customer intimacy back. You want to know your customer. So this is the basic pattern that you see. The first thing you have to do is collect the data. And we're talking, it's big data, remember, so we're talking billions of data generating people and machines. So classic spreadsheets, everyone's familiar with that. Publicly available data like directories, social media inputs, Facebook, LinkedIn. Increasingly Internet of Things, so these are thermostats, these are smart homes, grids like that. So now you can be extended or denied credit on the basis of what your thermostat tells about you. That gives us to big data. Of relevance to this group is going to be the transactional piece, and particularly the mobile aspect of that, because not only are you getting transactional information, you're getting transactional information that's based in a context. You know where you are, you know who it is. So it's a very rich type of data, and that's really what we're going to be talking about for the purposes of this. But once you have all that data, you have to do something with it, and that's the data analytics piece. And data analytics slices and dices the data, and it's very good because it's predictive. And what it does, it takes into account not just the content of the data, but also the context and the community. So what it can do is predict behaviors based on certain constellations of things. So for instance, based on everything I do, a profile is built of me. And how you assess credit risk is you take that profile of me and you compare it against the aggregate data profiles that you have from the millions of other people out there. So you know that if I look like those fellows in the back room there, who regularly gamble on the horses and don't pay their debts, on the basis that if I look like them, I'm not getting credit, or I'm going to get it at an exorbitant rate. But if I look like you over there, who regularly watches financial literacy videos and pays your bills on time, I'm more likely to get credit. And that's at a very, very high level how this works. And of course, on the basis of that, then you can offer all these sorts of solutions. And that's the piece of it, where you get, you can extend credit on that basis, you can reduce premiums, it decreases operational costs for the companies that are involved in this. So in a nutshell, that's kind of what this looks like. So because of the algorithm piece and the catchy name big data and data monetization, there's a tendency to conceive of this as sort of an objective process because it's science. And that's not quite the case, but we tend to ignore some of the problems that arise. So think for a moment, because there's probably fintechs in the audience, banks in the audience, and regulators in the audience, we're going to talk about Netflix, which is a safe topic. So think about Netflix. Netflix uses a form of big data. You've all experienced this. For those of you that subscribe, you know that based on what you viewed over here, it will make recommendations on these other things. So a couple of weeks ago, I got one of those recommendations, and it told me that because I had watched Star Trek, Netflix recommended Angelina Ballerina to me. So you can see where the system might break down a bit. Now, to be fair, I did not look at Angelina Ballerina, so maybe there is some subplot there that ties closely to Star Trek, but I kind of doubt it. So that's one of the problems that demonstrates the problems with these algorithms. The other issue is that there's no transparency. I don't know, I don't have any idea how that correlation was made. And I can't go back and fix it because I don't know what the data points are. I just know that somewhere in a black box, somebody at Netflix made that call, maybe just to mess with me. The other piece of this, and for those of you that have kids particularly, you know how you can poison the well. So back to the Netflix problem. Initially when Netflix came out, is even though people could share accounts, they didn't want to because they were very insidiously building up their profile. And they all knew that if the girlfriend looked at their things, then there would be no more Van Diesel videos. Instead, they'd be getting the Jennifer Aniston videos based on 5 minutes of accidentally viewing a rom-com. So that led Netflix to allow you to delete your viewing history. So you get a whole do-over. You can rewrite your entire life. But in the world of credit, that isn't a possibility. You can correct some of it, but you don't get a do-over. So see, there's some of the issues that arise. So here again, at a very high level, are some of the things you can do. Of interest to most people in this room will be the credit scoring piece, and I've explained a bit about what that looks like. You gather the customer data, you take those qualitative aspects, and you quantify them, and then you can do customer scoring models. Technology allows this to be done in near real time, and you can do improvements are possible. For instance, if after doing this, I'm told that my credit score is 2 out of 10, but if I watch these financial literacy videos over here, I can improve it to 3 out of 10 with the corresponding benefits. It's also used for marketing, and this is of interest to a lot of companies as well, because you can target ads. So no longer billboards by the side of the roads that hit everybody going by, and you hope that on sheer volume somebody will buy your product. Instead, you can slice and dice the data, and you can serve targeted ads to individuals who are most likely to buy your buy your product. This is that, they call it personalized contextual offerings. This is the customer intimacy piece. The other two are fairly obvious. Risk management, well, that sort of thing supports intelligence for terrorist activities, fraudulent transactions, insider trading, anti-money laundering. And the investment management side of it, those are the robo-advisors that you often hear about. So if you're a company, suppose really all you do is the credit scoring. That's your business. Maybe you do some ads. You target ads at some of the people, if you think they have mortgage products or something else. So you do it all internally. You've still got all that data that you've collected. Wouldn't it be great if you could sell that data or some of the insights from that data to another party? That, in a nutshell, is data monetization. So that's great. I mean, it's a whole revenue stream on something that you're already sitting on. So why isn't everyone doing it? Well, because lawyers. We get in the way of that. So that legal framework that I mentioned, I'm going to talk about the privacy regulatory aspects around this, and Anna's going to talk about the financial aspects of that. So privacy. We have a bit of a patchwork in Canada around privacy legislation. We have federal legislation that governs the use of personal information, and then there's a few provinces, and those are the ones in purple there, that have parallel provincial legislation. So BC, Alberta, and Quebec. Where provinces haven't passed their own provincial legislation, the federal legislation applies. So for all intents and purposes, I'm going to talk about the federal legislation, but the provincial legislation is substantially similar. Privacy legislation applies to personal information, and it really applies to pretty much every company that collects it. Like, commercial activities is broad. So if you're collecting personal information in the course of your commercial activities, you're probably caught by the privacy legislation. The other aspect of this we need to look at is personal information itself. Like, what is that? Personal information is information about an identifiable individual. Okay, well, what does that mean? That means that there's a serious possibility that an individual could be identified through the use of that information alone or in combination with other information. So that's really the essence of big data. The consent issue, you need consent to collect, use, or disclose personal information in Canada, and that's the cornerstone of the entire privacy regime. consent needs to be informed consent. It's only valid if the individual can reasonably expect you to do certain things with the information. Now, the Privacy Commissioner's guidance on this says that there's different types of information. It's kind of a sliding scale of personal information. And this is intuitive. There's name, address, sort of directory information. That's considered low sensitivity or non-sensitive personal information. And then there's the stuff that's really personal. That's medical records, salary records. That's sensitive personal information. The Privacy Commissioner has then said that, well, you know, there's different types of consent. So the nature of the consent is conditioned on the type of information. So non-sensitive personal information, generally implied consent will be okay. Implied consent is consent where I don't necessarily check a box or give you express consent. I'm not telling you that you can use the information. You can imply consent based on what I say or what I do. Good example, if I'm in a supermarket checkout line and I hand you my credit card, its consent is implied. I assume that you will use this to conduct the transaction. That's a reasonable expectation based on my behavior. And I expect you're only going to use it for that. Now, if you took my credit card and ran out of the store and tried to run down the street and buy something, that would probably be beyond what my reasonable expectation would be. For sensitive personal information, this is the medical records and salary information, for instance, express consent is almost always going to be required. So you can't imply that you have my consent to use that information. You have to actually ask me about it. And that's probably a good thing. I don't want my medical records out there unless you've specifically told me what you're going to do with them. And I might decide to say no. But of course, it's not quite that black and white. And there's always a gray area. That's how Anna and I make our living. The context of the information also matters. So think for a minute about a magazine subscription. Subscription information consists of name, address, phone number. So subscription to a news magazine. Is that going to be personal information or sensitive information or non-sensitive personal information? Show of hands. How many in the audience think that is sensitive personal information? Good crowd. Nobody thinks that's sensitive. Now, what if that same subscription information, so name, address, phone number, is now for a magazine called Naked Girls with Big Butts? How many now think that is sensitive personal information? I mean, there's a few in the audience. The rest of you are very cavalier. I've got to say, I played around with the title to try and find, I wonder how far I could push that until there's one person in the back saying, oh no, that's not sensitive at all. So let's go back to the Netflix example. The reasonable expectation is what you collect the information for. So when I hand my personal information over to Netflix, I expect it to do a couple of things with it. I expect it to give me invoices and charge my accounts for the service. I expect them to make movie recommendations. But what if they also used that, my viewing history or my personal information, to set prices for the service? So for instance, what if I watch foreign films and BBC documentaries, and as a result, I have to pay twice what Anna pays because she watches American Ninja Warriors? Is that a reasonable expectation? Would I anticipate that being done with my personal information? What if Netflix is then selling that information and those insights to others to make loan decisions or health insurance decisions or other decisions? That sort of starts moving you out of those reasonable expectations. And that really gets us to the crux of the problem. It's all about this consent issue. So I want to talk now about a case. This was the Bell Relevant Ads program. It was about a year ago. Bell Canada got in trouble with the Privacy Commissioner because it tried to do some out-of-the-box thinking, which is never a good idea. So Bell, in the course of doing what it does, which is offer phone service, cable, internet, collects a whole bunch of information. Network usage information, page views, subscription information, gender, age, payment patterns. They're really sitting on quite a lot of data. Bell sensibly looked at all this data and said, we can probably do something with this. Now, they had collected all of this data for use in the core business. In other words, all the stuff we just discussed. So they took this info, they weeded out the sensitive stuff. So they'd been paying attention to what the Privacy Commissioner said. So they took out any information about health, any information about children, any information about sexuality. All the sensitive stuff, they chucked it. They then took these individual profiles and sliced and diced them into categories. The categories themselves were also non-sensitive. So there was no health category. They were just, males between this age and that age, males who watch hockey on Saturday. It went to advertisers and said, we have all these profiles. They're pretty precise. So you can pay us and we will serve ads to the customers that fall into these profiles. So if you fell into that hockey viewing 35 to 40-year-old male demographic, third parties would then be able to place ads right in front of you. Great. Privacy Commissioner took a different view. And the reason they took a different view is very interesting. So Bell had taken this non-sensitive personal information to categorize individuals into non-sensitive categories, but let me try again. They used non-sensitive personal information to categorize individuals into non-sensitive categories, but that somehow transformed the information into sensitive information. So in other words, so much information went into these profiles that the Privacy Commissioner took the view that it had become sensitive personal information. So poor Bell was on one side. Everybody agreed that the starting information wasn't sensitive at all. So what happened at the end of the day, Privacy Commissioner says, no, this is all sensitive information and you need express consent. Bell did not have express consent, and it took a very different view about whether it was required. As a result, Bell ultimately ended up scrapping the program. There was another piece of the decision from the Privacy Commissioner, and it said that the quantity of the information alone can render non-sensitive information sensitive. So at what point then does a valid collection of non-sensitive information become an invalid collection of sensitive information? Where's that bright line? How much data is too much data? And this was the problem that Bell was facing. And it raises an interesting question too, not just when that line is, but if that line is crossed, what do you have to do with that data set that's no longer valid? At the very least, you can't use it, and there's privacy legislation which suggests you may actually have to delete it. So if you're a company that uses big data for this, that could be really problematic. The other piece that was raised by the Privacy Commissioner was the piece around reasonable expectation. The Privacy Commissioner found as a fact that consumers would expect to have received opt-in consent. Bell took a different view. And the reason the Privacy Commissioner found that opt-in consent was what people expected was because they found that Bell had collected the information for one purpose, but used it for a secondary purpose. And they felt that people wouldn't understand this switch of uses. And that's a problem that arises similarly to that arises in some of the financial regulation.
So switching gears to the financial regulatory aspects, what's interesting here is that depending on the type of entity that you are, you may or may not be able to conduct this type of activity. And drilling down into this, it's because banks are, under the Bank Act, limited to only carrying on the business of banking and such business as generally appertains thereto. And that's a prudential limit on a bank, and there are good policy reasons for that. One is to ensure the safety and soundness of banks, to ensure they're not engaging in activity that is far outside their expertise when they're holding deposits for customers. Another one is a competition aspect. Banks have access to deposits which are very cheap capital. And so if they were engaging in general types of business as a normal corporation would, they would have an advantage in terms of competition. So there is that general prudential limit on a bank, which exists in the legislation, and more particularly, there's a section that states that a bank cannot engage in any trade or other business. These are very broad limitations. There are specific exceptions that are set out in the Bank Act, et cetera, but that's kind of the general framework we're operating under. And similarly, federal trust companies are subject to similar limitations, and insurance companies as well, limited to financial services business. And again, that is a prudential limit to ensure that those types of entities remain safe and sound. Fintechs, on the other hand, are corporations or partnerships, and as a result, they're not subject to prudential regulation. They can engage in whatever type of business that they want to, as long as it's legal, and are subject to just general laws of application. Of course, they're subject to privacy legislation, as would banks, et cetera, but they're not subject to, by virtue of their nature, limited types of business. They can engage in whatever type of business that they want. So drilling down further in terms of understanding what is the business of banking, because that is a very broad term, helpfully, OSFI has set out in a ruling where they refer to prior case law, that it's not a static concept. It's a concept that evolves over time. You know, what was banking at the start of the 20th century is not what banking is today. And you know, the business of banking is what they define as activities that banks generally undertake both within and outside Canada. So there's a definite reference there to international, which is helpful as well. So the question is data monetization an activity that banks are generally undertaking? And what's you know, there is not much happening in terms of data monetization internationally that we're seeing. But that being said, generally there is a convergence of technology in banking that we're seeing, where technology companies are acting more and more like banks, and banks are acting more and more like technology companies. And the Bank Act is currently undergoing its process of review. It does a regular amendment review, which is typically every 5 years, and was actually delayed to 2019 instead of 2017, in part because there's a lot happening in the world of banking right now. And in that context, you know, what is the business of banking is something that's being looked at in terms of whether there needs to be some expansion there. And we're talking about it here in the context of data monetization, but it's a general point in terms of the fact that the business of banking would affect the ability of a bank to engage in a substantial investment, potentially in a fintech, because you can't do through a subsidiary what you can't do through yourself. So as a result, you have kind of a dichotomy now where the business of banking is limiting some ability of banks to compete with fintechs. So in the context of the Bank Act amendments, the business of banking is one of the portions of the Bank Act that is under review. Another piece of area of legislation that's relevant here is credit reporting legislation. And Kirsten mentioned a lot of contexts in which credit reporting comes up. And the activity of furnishing a consumer report is regulated activity. So Equifax is a licensed credit reporting agency, for example. And you can't, as you know, a normal unlicensed corporation, start selling credit reports to whoever you'd like. You have to be a licensed entity. And the definition of consumer report is quite broad. It doesn't need to look exactly like an Equifax report. It's any personal information or credit information that's used for the purpose of determining creditworthiness. So there is a possibility there, based on what the information is being used for, to fall into that kind of category where you start entering into licensed activity. Credit reporting legislation generally is under pressure right now as well, because we're now seeing, as Kirsten mentioned, use of unconventional data points for credit reporting and a lack of transparency. So there's right now a whole regime where you can get a copy of your credit report and you can question what's on it, you can get it corrected, et cetera. But once, you know, the data is kind of a black box and people are using, companies start using things like social media profiles or university scores or very unconventional data points to credit score, it starts to put a lot of pressure under the current credit reporting legislation model. And so there is some activities by regulators starting to look at that, especially in the US. The CFPB has at times you know, started to look at that. And so that is an area of legislation as well that's affected by data monetization.
So where does this leave us? We've told you about all the things that are possible, then we've told you about all the reasons why you're not supposed to do it or the challenges involved in that. So we have to bridge that divide somehow. The regulators usually say that they aren't interested in stifling innovation, but then that raises the question of, well, how can you regulate but still allow businesses to be businesses, but protect the consumer interest? So there's a number of things on the table right now. From the privacy perspective, right now the Office of the Privacy Commissioner of Canada has published a discussion paper around the consent model. It's live to all these issues. It realizes that the current consent model doesn't work in the world of Internet of Things and big data and data monetization. So it's called for submissions to consider this consent model. It's done a very good survey of other jurisdictions, and it's pulled together how other places handle this. And then it's asked a number of very good questions and is asking for people to submit their views on which direction the legislation should go in the future. I believe submissions are due July 13th, so I encourage you to take a look at the paper. It's short, it's readable, it's got pictures. It won't take a lot of time. And I encourage you to make submissions because this will have a significant impact.
And I mentioned on the regulatory side the upcoming Bank Act amendments, in terms of whether or not there'd be some expansion now in the business of banking. And definitely in the context of data monetization, there is uncertainty there. And that is a point that as banks start to act more and more like tech companies and want to also realize the value of their data, that's a pressure point that may be something that starts to move some of the legislation.
There's also risk mitigation, which is what you can do right now. I think probably the key takeaway here is that it's no longer just enough to slap up a generic privacy policy on your web page and assume that that's going to be enough. You really do have to take a look at what you're doing and what consent is being given. What can you do with the consents that you have? And if you're embarking on different ways of using personal information, make sure you've thought it through very carefully. And there's some lessons from other jurisdictions as well. So the EU, like Canada, says you can only use personal information for clearly stated, explicit purposes. But it also says that consent is just one of the bases on which you can use personal information. There's a number of other types of things that you can use. For instance, enabling the performance of a contract. You don't necessarily need consent. It's a way around it. One of the criteria in the EU legislation is about supporting the legitimate interests of an organization. And Canada doesn't have that kind of exemption from consent. So the General Data Protection Regulation, the GDPR, which is set to come into force in 2018, says that businesses don't need to rely on consent if they can prove the data processing is necessary for the purposes of the legitimate interests of the organization. And then there's an override for concerns around human rights and individual interests. But there's now a discussion going on about whether this is a model that Canada should adopt and whether the legitimate interests of an organization, for instance a bank, in monetizing data to allow it to innovate fall into this category. So there's an interesting discussion around that.
And what's interesting really is that Europe is typically more strict on privacy.
Mm-hmm. And you see that there's been some evolution there. For instance, Barclays has recently decided to monetize its data. It's a fairly new project, and it can do this because the privacy regime has this legitimate interest or legitimate purposes sort of loophole that allows it to do that. Now, it's relatively new. It remains to be seen what the regulators do with that.
And what's interesting on the Barclays example is, as far as we're aware, they didn't seek any sort of ruling or exemption under their limitation on the business of banking and just proceeded with that activity. And that really goes back to that definition of the business of banking is what banks are generally doing. And so as they start to possibly do this in other jurisdictions, that may switch and move the definition more to make that part of generally the business of banking.
So we have some time and we invite questions. Please, that's the most interesting part of this.
Sorry, can you explain a bit more what Barclays is doing?
Barclays is using, and this is mostly on published reports and what's available from their website, but what they've done is essentially monetize their data. They've taken the transaction information that they have, they've built profiles based on consumers, and they are selling reports, insights, essentially dashboards. There's an Australian bank that does this too, but I cannot remember what it is. And you actually, if you go onto their website, you can see the type of insight reports that you can get, and they're quite interesting. Sorry, I can't hear you.
So in Canada, are they doing that on the basis that their customers have signed an intergroup agreement to share data?
As far as I know, it's only based out of the UK right now. I don't think it's migrated to Canada. I think they would have some problems with that here.
And there's probably a lot more happening on the data monetization side. It's typically very sensitive commercial information, what banks are doing on this, and they're not sharing much about it. But you know, if you read American Banker, data monetization comes up all the time. It's clearly something the industry is very interested in right now.
Yeah, and how a company chooses to monetize its data is something that is not widely shared. It certainly gives a company a competitive advantage, not only the type of data that they're sitting on, but what they choose to do with it and how they do it.
Is there a way that this is being done that could be seen to be in, say, consumers' interest, like it's going to be packaged or used maybe perhaps by Fintechs to create new products? Or, I mean, I'm just trying to get a sense of, I know this happens with political parties elections. I don't know that the average person
For sure, there are definitely fintechs doing interesting things with data, and a lot of it's on the consumer reporting, credit reporting score side. You see in the U.S., so I mentioned university grades. That's something that some online lenders are looking at, especially trying to figure out how to credit score unconventional borrowers that may have low credit scores based on conventional means, but actually have a lot of source of wealth through some or future income through some other ways. And in that way, you're actually providing services to people that otherwise you may not be able to provide services to. So there is a lot that could be done with this data. We're not saying it's a negative use of data by any means.
Privacy Commission is certainly aware of the issue. I expect they will move on it shortly. They know that, I know from conversations with that office, that they're watching not just fintech, but big data more generally. There's certainly increasing collaboration between the Privacy Commissioner, the Competition Bureau, and other agencies looking at this sort of thing. But not all uses of big data and personal information are evil. For instance, there's some very good, some interesting developments around financial literacy, and this is sort of the gamification of big data. So if I apply to a company and I get a loan and I have this horrible interest rate, I can then take steps. For instance, if I watch this financial literacy video, or if I learn about this, or click here, or do certain things, my credit score, as decided by that company, improves each time I go up, as does my financial literacy. And so there's arguably a consumer protection interest there. The flip side of that is that it's also been accused of being very paternalistic. I don't have the benefit of knowing what the various models are. I don't get to see the back end, unfortunately. But in large part, the difficulty with Bell was that it was seen to be a monopoly position. And in particular, Bell was entrusted with all this sensitive personal data. In large cases, it was. The Privacy Commissioner took the view that because you had this full universe of data about an individual, that it had been entrusted to Bell for only that purpose. And because of that sensitive nature, the whole thing sort of broke down around the opt-in versus opt-out consent. The other companies that have come subsequent to that have taken that learning and have tried to achieve the opt-in consent. But again, I can't go further than that because I don't know what's happening on the back end and who the partnerships are with in terms of who's monetizing the data. A lot of the companies that do this don't do it themselves. They have processing agreements with third parties and analytics firms that do it. Is that it? All right, I think you've bought yourself an extra 5 minutes. Thank you very much.
Thank you.